Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, February 27th, and today the market's vibe is, "I'm fine," said through clenched teeth.
Clenched teeth is also my budgeting method. If I don't open my mouth, I can't accidentally say yes to a subscription.
Three big themes: a massive OpenAI funding round and what it means for the AI trade, U.S. producer inflation coming in hot and pushing rate cut hopes out, and Germany's inflation easing to the ECB's 2% target. Then a quick reality check on global debt.
So we've got robots getting richer, prices being rude, and Germany being responsibly calm. Let's go.
Story 1. OpenAI reportedly closed a $110 billion funding round with backing mentioned from major names like Amazon, NVIDIA, and SoftBank. Whether you love or hate the hype, that number is a signal flare for where private capital thinks the next decade of cash flows might live.
110 billion. That's not a round, that's a planet. At that size, do you still call it funding, or is it just summoning money?
Simple version of the finance. Private rounds set an anchor valuation. That can pull public comps around, chip makers, cloud providers, and AI-adjacent software, because investors start doing the math backward. If the model layer is worth X, what's the infrastructure worth?
So it's basically like your neighbor lists their house for a ridiculous price, and suddenly your whole street thinks they're living in a luxury zip code.
Exactly. But here's the catch. Private valuations can be sticky and optimistic, while public markets reprice daily. If rates stay higher, the discount rate rises, and long-duration AI future profits get marked down fast.
The robots can be amazing, but if money is expensive, investors suddenly remember they like profits that exist this calendar year.
Why it matters for normal people. First, jobs. Big AI funding accelerates automation and also creates demand for new roles: data center build-out, security, compliance, product integration. Second, your portfolio. Concentration risk. If your index funds are already heavy mega-cap tech, you may be more AI bet than you think.
Actionable move. Check your holdings like you check ingredients. If the top 5 positions are basically chips, cloud, and vibes, you might already be overseasoned.
Story 2. Stocks fell after stronger than expected PPI data, reinforcing the idea the Federal Reserve may not cut rates anytime soon. PPI is producer price inflation, what businesses pay at the wholesale level before it hits consumers.
So PPI is like the receipt the economy gets before it Venmos you the bill with a service fee and living in 2026 surcharge.
That's the analogy. If PPI runs hot, companies either absorb it, hurting margins, or pass it through, pushing CPI later. Markets react because inflation persistence keeps policy tight, and tight policy usually means higher borrowing costs and lower valuation multiples.
And the market hates 2 things: uncertainty and math. Mostly math.
We also saw a specific data point. Core wholesale prices rose 0.8% in January, much more than expected per the headline. Core usually strips out volatile items, so when core is hot, investors worry it's not just a one-off.
0.8% in 1 month sounds small until you remember inflation is like glitter. It gets everywhere, and you're still finding it on your budget 6 months later.
What to do with it? If you're a household, this is a reminder to stress test your finances for rates stay high longer. Think, keep an emergency fund, avoid stretching on variable rate debt, and be cautious about assuming refinancing will save you soon.
If your plan is, I'll just refinance, today's data just walked into the room and said, not so fast.
Story 3. German inflation eased to 2%, right at the European Central Bank's target, while the recovery is described as starting slowly. That's meaningful because Germany is the euro area's largest economy, and inflation there heavily influences ECB confidence.
Germany hitting 2% is like your friend finally arriving exactly on time. And you're like, great. Now, can you also fix the rest of Europe's group project?
Finance behind it. If inflation is at target, the ECB has more room to consider easing if growth is weak. But central banks won't cut just because they can. They cut because they must. The slow recovery line suggests the growth side of the mandate is still a concern.
So for investors, Europe might look like less inflation stress, but also don't expect miracles, like decaf espresso. Still coffee, just emotionally softer.
Now the backdrop risk. Global debt reportedly hit $348 trillion in 2025, up about $29 trillion in a single year, driven largely by the US and China. In a higher rate world, debt servicing costs become a bigger drag on budgets, public and private.
That's the part where everyone says, it's fine, but the credit card is quietly doing CrossFit.
Quick recap. OpenAI's huge funding round is a sentiment signal for the AI build-out, but public markets still live and die by rates. Hotter PPI, especially a 0.8% core wholesale jump, keeps higher for longer in play. Germany at 2% inflation helps the ECB's comfort level, but growth is still the question. And global debt makes rate sensitivity the long-term plotline.
And your actionable homework. Check concentration in your portfolio, don't build your life around a near-term rate cut, and keep your cash cushion like it's a personality trait.
If you got value, subscribe and share the show. This is BD Daily Finance News Podcast, your daily briefing on finance and investing. We'll be back with the next briefing.
And if your friend says, inflation is over, send them this episode and a calculator. See you next time.